Hey guys, it's Jeremy Hands, co-founder of Climb Capital. Really excited to share with you today about what we got going on. We are buying RV parks and destination campgrounds across the Southeast and across the Sun Belt in the United States. After years of doing real estate, going full cycle on dozens of deals, and even leaving the military full-time to come pursue this opportunity, I'm really excited to talk to you about the Campfire Fund and all the opportunities that we think that it provides right now.
I'm Bob Preston, co-founder of Climb Capital, and I'm here to talk to you about the Campfire Fund. We're buying campgrounds with a destination vacation feel. We buy parks that are close to interstate exits. We buy parks that have natural or man-made amenities, like this beautiful brand new pool. We have guests that are responsible, they pay ahead of time, they love being at our park, and we make sure that when they leave, they give us a 5-star review.
Hey guys, what's going on? My name's Jake. I flew for the Marine Corps, flying helicopters, attack helicopters, and training aircraft for about 15 years. One of the things that I think obviously drew me to Climb is because of our military and our aviation background. What we are doing when we're flying is essentially always solving problems. Something is always changing. The environment is changing and changing and changing. That's what happens in real estate and business in general. Something changes, we adapt, we overcome, and we succeed.
Hi, my name is Ashley and I run RV parks for Climb Capital. When I first got to this place, it was a total wreck. Now we've renovated the pool, we put in a fire pit, we brought in these really cool cabins, we sell firewood, we refill propane tanks, and they love it.
You've worked hard for your money, and you deserve an investment team that knows what they're doing. We've bought RV parks and we've sold RV parks full cycle. We know the customer because we are the customer. For us, it's more than just a business, it's a business and a lifestyle.
We have a competitive advantage in property management. Traditional apartment and residential property management just doesn't work for RV parks. This is a hybrid hospitality business, and we spend the last few years perfecting in-house a property management company specifically focused on the RV park industry, and that's why you should invest with us.
Hey, my name is Alex. I want to tell you about this Campfire Fund. RV parks have been around for a long time. So what changed? Why now? Technology and data collection have changed. The existing owner base for RV parks has not kept up with the new shifts in technology, but we have. Pretty soon, the institutional money is going to come into this space and they're going to price out smaller investors. That's why our moment to invest in this asset class is right now.
All right, well, we will get started. Okay, thank you guys so much for joining today. We are super excited to talk about the Campfire Fund. So I am Carter Moses, Climb Capital's Director of Acquisitions. And with me, I've got Cliff Luber, one of our co-sponsors. So gonna pass it over to him to kick us off.
Thanks, Carter. Hey, everyone. Thanks for joining us today. We're very happy to tell you about the Campfire Fund. And as Carter mentioned, I'm Cliff Luber, one of the co-sponsors working with Climb Capital on this fund. So first, to get started with a few disclaimers. So keep in mind, this is a 506c offering for accredited investors. If you're a non-accredited investor, you can still watch today, but you do have to be an accredited investor in order to invest in the Campfire Fund. All of the numbers that you see today are projections that we have, we deem to believe reasonable and conservative. And also, this webinar is for informational purposes only. So anything that you're looking for specifically for this investment is going to be in our PPM, which is otherwise known as a private placement memorandum. You can receive that by emailing info@climbcapital.com, and we'll be more than happy to send it your way for you to review. So the bottom line of why we're here today, we believe the RV park industry is the best opportunity in real estate, and specifically commercial real estate right now. And Climb Capital is an industry leader already in this emerging asset class. So let's go ahead and explain a little bit more about why. So for this slide, if you'll kind of bear with me a little bit, this is a very high level slide that explains why we believe RV parks are the next asset class in commercial real estate. So let's look at that by looking first at two other asset classes and the trends that they saw throughout their life. So this slide here is a spectrum going from left to right. And on the left side, you'll see how every investment starts with customer demand and then innovation. So let's go ahead and go back 200 years in American history, which I know maybe not a lot of people do on an investing webinar, but let's look at like the beginning of the Industrial Revolution in like the late 1700s. Back then, multifamily housing was not nearly as prominent until cities grew and expanded to become the center of American life. And cities were no longer just somewhere where you visited every few weeks to get supplies. So then once cities did grow in the Industrial Revolution, there became this need for mass housing. And eventually it became moving along to the right of the spectrum, became widely disseminated, and then a commodity, which is what it is today. The same exact thing happened with self-storage or mini storage as an asset class. So there was initially consumer demand as people, in the post-World War II era, and even in the 1900s, early 1900s, began accruing stuff. And then it was like, okay, where are we going to put this stuff? And self-storage kind of became an answer for that. So we see RV parks as kind of being a little bit behind those two asset classes, but that's why we believe it's a great opportunity to invest now and with the Campfire Fund, because it's still in the development phase that is yet to be, provided on a mass scale and also not quite yet commoditized. And if you think about it, the SUV as a whole wasn't invented until just after World War II. And so this asset class has a lot of room to grow, yet has the same predictability from a commercial real estate perspective as multifamily and also self-storage. We just don't see it quite at the commodity level. So following this pace of and the macroeconomic trends of other asset classes, we believe we're perfectly poised to exit the fund within a few years, as we'll talk about a little bit further. And now back over to Carter.
Okay, thanks, Cliff. All right, so why RV parks? We have come up with this DRIVE acronym as a way to describe our top reasons as to why RV parks make a great investment. So first up, we've got diverse customers. RV parks offer the unique ability to target a wide range of individuals that appeals to all demographics. So RV parks are not a new thing. People have been choosing to go on RV vacations for years, and there are many people who would choose to live full-time out of their RV. However, in recent years, due to the changing macro trends towards remote work and an emphasis on outdoor recreation, we've seen a real uptick in younger generations purchasing an RV. So 22% of RV owners are now between the ages of 18 and 34, with the largest age demographic being 35 to 54-year-olds. When we first started looking at RVs, I think I was one of the majority of people that were like, oh, RVing and RV campgrounds are probably for retirees. Those have got to be the biggest asset class, but it's not. We ourselves are RV enthusiasts, and we have continued to see this increase in people staying at RV parks that we're currently visiting with our friends and family, and those that we own. So even in talking with fellow investors, family, friends, and honestly, even lenders that I have discussions with, they're expressing this desire to go RVing. So we do not expect this trend to slow or stop anytime soon, and it's just going to continue to diversify. So next one is recession ready. RV parks are going to exist if people are making a lot of money or a little money. People are going to still be taking a vacation. And we have seen this in the recession in 2008. We've seen it this year with gas prices rising, and we're continuing to see it as the market is starting to turn. So people might not be going to Europe or traveling across the country to go to Yellowstone, but they are choosing to go shorter distances in their RV to spend quality time with their family and also to experience the outdoors. According to a latest cost comparison study done by the RV Industry Association, which was completed about a few months ago, an average four-person vacation using an RV travel trailer is about 31% cheaper than staying in a motel and driving a car. It's also 50% cheaper than flying and staying in a hotel. So the other thing about RVs is if things get really bad within the economy, they can be used as low-income housing for a time and then just convert back to more vacation style RV parks. RV parks are also able to be converted to mobile home parks with limited additional CapEx added. And another alternative is many RV parks also have additional land on them that you can use to convert to more storage. Since there's been this increase in RV sales, there is a shortage of storage options. So many people in the past few years bought an RV and then they realized, okay, where am I going to put it? I've got an HOA, store it in my driveway. And so they're now in search of options that is in a market that is already lacking supply. So, and finally, there's an option to use an RV park as a land play. So we're buying these RV parks in destination areas where people want to live with significant amount of acreage at relative prices that still cash flows. So even if there is a recession, there's still going to be money to be made in these alternatives that we can then use as a good investment option for our investors. We also have industry fragmentation. So over 70% of RV parks are independent mom and pop owners. And many of these owners have been living and owning and operating these parks for 10, 20, 30 plus years. So this is great for us in multiple ways. It allows us to increase revenue immediately by creating operational efficiencies, such as implementing on-site professional management, expense reduction, add ancillary income options, and also provide amenities that customers really desire, which is going to drive up your NOI. We also don't have to compete on brokered deals. So we're able to negotiate better terms, which really includes owner financing. And in that market, in this current market, it is super imperative to get these owner financing with debt prices rising as they are. Additionally, it means that there's also not a ton of institutional players here yet. So we're ahead of the game. And since there's not a lot of these larger players, research is more difficult to find. Whereas you can Google for market research to find stuff on multifamily or self-storage in whatever area you're looking to buy, it's a lot harder to find this on RV parks. So with our 9 parks that we own, we've really been able to cultivate this data to better evaluate deals and the market, which is a really big plus and gives us an advantage over groups looking to get into this space once they realize how much opportunity is here. RV parks also offer versatile revenue streams. So on top of the traditional nightly, weekly, monthly, or seasonal pad rent, you're able to implement additional revenue, including but not limited to Airbnb revenue from cabins. You can have propane, firewood sales. You can add a laundry facility, sell Wi-Fi upgrades, which we found is super successful within our parks. You can rent golf carts, kayaks, canoes, boats. You can offer storage, so many different ways. And actually, one of our property managers just went to a conference a few months ago where one of the owners said that they created a few spots that had their own closed-in dog area, and they were able to charge a premium for this. And honestly, we talked about it. We really like that idea. We'll probably implement it at some of our parks. So there's just so much opportunity to be had in this space and to create additional revenue. And then lastly, we really like the exit flexibility it offers. So we can sell these parks individually as a package to a group, use the opportunity for a land development play, or just sell them to a portfolio to a large institutional group that wants to come into this space with scale. Okay, so asset level opportunity. What are we doing with the Campfire Fund and what deals are we looking for? Essentially, what is our buy box? So we are looking for already operating RV parks that are making money right now. As I kind of mentioned before, these are typically being run by mom and pops and are not being maximized to their full potential. And that's going to present us with opportunities for us to come in, make it better, increase revenue from day one. So within the buy box, we're specifically looking for 1, deals in the Southeast located near a major market or tourist attraction that people want to live. 2, have convenient access to an interstate or major highway. 3, are large enough to support a full-time on-site management team to really give the guests that high-end service. 4, offer amenities and specifically a water feature, as we've found that this is the top amenity requested by residents and especially families that are looking to go on vacation. And then finally, we're looking for a value add component for property upgrades to either add additional pads, raise rates to meet the market, or provide amenities to attract customers. So when we find these parks, they are usually missing out on some bigger picture business item, such as not providing online booking or a modern website. The owners are doing everything themselves without a management or maintenance team, which kind of leads them to not having strong financial recordings, which is really important to provide good debt. They may be missing out on revenue by not instilling dynamic pricing or offering additional revenue streams, such as billing back for utilities. And the reason that we've seen a lot of owners not do this is because they've grown to really know their residents well from living in the park, and they're making do by the revenue that they currently have. So they're not pushing it. So this is where we come in, take it, the mismanaged park, that is located in a really great area, and we put in our strategic operating system to optimize the park and generate strong returns for our investors. The other thing we look for is parks to have undeveloped or unused land where we can add additional pads. So we're not trying to go in and develop land, right? Develop these parks. It takes up a lot of time and a lot of money. And so we're looking for parks that are already operating with cash flow and have the ability for expansion if we would like to add that. So as we build out these parks and institutionalize them, we now have well-performing, attractive RV parks that are valuable to exit. So we can do this in various ways by selling them individually to a person or group. We can package them to an institutional buyer. And we really, truly believe that there's going to be an influx of these groups coming out of New York, California, Florida, and they've been focused on multifamily, the hotel sector, even mobile homes. And they're going to come into this space looking for the yield and opportunity that it offers. And we're really already starting to see this as some of these REITs are coming in. We've got large wealth groups such as Blackstone are already acquiring RV parks. So we have the option to actually, we're already ahead of the game, right? We already own some of these. So by them coming in a little bit later, we're already prepared ourselves well. And then we also have the option to recapitalize the portfolio, buy out the investors that want to exit, and keep the investors that want to stay for more of a longer term hold that cash flows.
So let's talk a little bit more specifically about the Campfire Fund itself. So in the context of how you're approaching it probably as an investor, there's a lot of inflation, market volatility, and global unrest out there. And it's stressful, it's uncertain, and the financial world is having trouble finding what assets are best to invest in that yield both appreciation and also cash flow. And we truly, truly believe the Campfire Fund is the answer to that. So the Campfire Fund is raising $20 million, and we're going to use that money as down payments and also to begin the value add plans on the parks that we do purchase. And we're going to purchase 10 to 20 resort style RV parks with amenities and all of the things that Carter has already kind of discussed, and we'll discuss on the first two assets that we've already purchased under the fund. The 10 to 20 range is mainly because we don't exactly know how big each and every park will be that we purchase, but with the $20 million utilizing and putting that capital work, we'll buy somewhere in that range of 10 to 20. As far as the locations go, we're ultimately looking for anything in the Sun Belt. We have a lot of parks in most of the states that you'll see here that are in the Southeast and are looking to expand a little bit further westward as well. And the idea is below the freezing line, buying land in great locations where people are traveling to and wanting to vacation, particularly year round, or at least as many months of the year as possible. And that's how we thrive running a hospitality short-term rental type resort style RV park. In the bottom right here, you'll see the two different asset classes for how you can invest, but we'll talk a little bit here on the next slide about that. So there's two different investment classes that the investors are allowed to choose. The first one is yield. The yield class has an 11% preferred return, and you also get first priority distributions every quarter. So if you're not familiar with the term preferred return, it essentially means that the general partners, so Climb Capital as well as myself as a co-sponsor, are guaranteeing that you're going to get an 11% preferred return before we make any money. Now, no return financially is ever guaranteed, so I do want to clarify, but we as the GP will not be making any money until you make your 11% preferred with the yield investment class. However, there is no equity upside beyond the 11%. If you're interested more in the upside, then shift to the right of the screen and look at the equity class. So the equity class offers a 7% preferred return, so slightly lower quarterly payout, slightly lower preferred return that you'd make before the general partners would be paid. However, everything after 7% is going to be profit split, 60% going to the LP and 40% going to the GP that is above the return. And also our projected IRR for this fund is in the 15 to 20% range. So if you believe that we're going to exceed the 15 to 20% range or hit that range rather, then perhaps you want to consider the equity investment. So lots of different decisions that you might want to make with your CPA, your lawyer, your family, but we're also happy to discuss that at follow-on calls. If you email info@climbcapital.com, we can help you get started on that. Now back over to Carter.
Okay, so why should you invest with Climb Capital? So Climb Capital started off buying value add apartments towards the end of 2020 and 21. With how competitive that multifamily space was and all the institutional capital coming into those more secondary and tertiary markets, it was really hard to compete on deals and still provide our investors with strong returns. So we sat down as a team, looked at our portfolio, and the one RV park that we bought at the time, honestly, kind of on a whim from one of our owners, Bob, who went on vacation and stayed at the park with his family, was really overperforming. So we started really digging into the market and the industry, saw its potential, and we made the hard decision to pivot. So we transitioned our property management company, Altitude Property Management, which only manages our own deals, to be solely focused on the RV park niche. So our property managers are now focused on providing top of the line guest services in a hospitality mindset. This is one of the major reasons why individuals and some of the larger groups just haven't broken into this space yet, as managing an RV park is very different from multifamily. And there isn't just a hotline for you to call and say, hey, I need to find a manager, right? Or there isn't really any third-party management services that solely focus on this. So you need to take it on as a business, and it's a full-time endeavor for us. We think we have the right people and created the right system to be successful. And it all starts with hiring the right person. So we provide our management with the tools and training to run the property and give them the ability to treat it like their own business. So we really look for entrepreneurs in this space so they can take pride and ownership in their park. It also allows them to make strategic decisions by, maybe changing how many spots are set aside for long-term users at the park. If there's an influx of travelers coming down for the summer months, or maybe you get more snowbirds. Or let's say there's a festival that weekend, they're able to actually adjust the rates to meet the higher demand. So they're constantly optimizing the revenue and are incentivized to do this. The next is we're focused on communication. We have weekly meetings with all of our property managers and host meetings within Pensacola, which is where we're based, with all of our managers at least once a year to have training sessions, team bonding activities, and we'll sit down and actually strategize and learn from each other as we continue to expand on what's working and what's not. Technology is also super important to us, making sure we've got the latest technology at our parks in order to enhance tenant experience, as well as operational efficiency and reporting is going to be key, especially as we go and position these parks to be ready for institutional owners. And then lastly, we are vertically integrated, meaning we have all of our people are in-house, and that lets us have the ability to be fully aware of all aspects of our business, from the management side to acquisitions to investor relations, and we can easily make adjustments as necessary in order to succeed and provide the best returns for our investors. Okay, so here's our track record. This is not our first deal. We have had 24 commercial real estate transactions. We currently own and operate over 1,000 sites with 50 million assets under management, and we've gone full cycle on 11 deals. And if you want to hear about any of those, feel free to reach out. And honestly, we get very excited talking about deals, so we will be sure to go into the 11 full cycle deals if you'd like. Okay, and then here's a quick graphic to show our current RV portfolio. So our newest additions, which are also included in the Campfire Fund, are shown in black, and those are Nashville North and Arrowhead RV Park. But the area. Okay, so our most recent deal that we acquired is Arrowhead RV Park. And apologies in advance if I get very excited talking about RV parks and go kind of rattle off a bit. But we found this deal through a woman that runs the company that actually develops our cabins for our RV parks. So she happened to know the owner who passed away, and his son who inherited it didn't want, nor did he really know how to operate an RV park, let alone do an RV expansion. So we reached out to him and were able to get it under contract at $3 million. Which is a really great price considering the park was making money. It was operating really well. And, some of the vacant spots along the Smith Lake that this is on, we're going for more than what we bought an operating park for. So really excited about this offering. It's over 45 acres right on Smith Lake, which is one of the top lakes in Alabama and is directly between Birmingham and Huntsville, one of Alabama's top cities. It currently has 40 RV sites. It's got 20 plus boat slips, 36 storage units. It offers some amenities, including a new pool, and is one of the only waterfront restaurants with a liquor license on the lake. However, the best part about this deal is the opportunity to redevelop it to a Class A RV resort and adding additional 150 pads as well as high-end amenities to really make it that vacation style park. So it is a development opportunity, but there's cash flow day one from those 40 existing spots, and there's additional upside by bringing these rents up to market within the first few years. So current ownership was charging, $260 to $300 per month, which is well below average. They had no short-term spots, while the other parks right along the lake were charging $50 to $60 per night, $200 to $300 per week, which was more than than the current ownership was charging for the month, and they were charging around $600 plus per month. So there was a ton of opportunity here to come in and start, increasing things day one. We also own a park kind of right up the road. And so we know the area really well, and we have a really good property management team to cover this park. So one other thing that I kind of want to mention on this deal is we were able to get some great financing through our lender relationships here. So it came in around 69% loan to cost, which ended up being, 4.2 million-ish. We're planning around 3 million in development / CapEx to put here. And we're able to get a 10-year fixed rate loan at 4.75% for 10 years with 2 years interest only and no prepayment, as we'll likely look to probably redevelop this in year 3 unless, the debt market's not there yet. Okay, so if you look at the returns perspective, what does this mean for you? We've kind of provided a sample investment to give you an idea of what it might look like based on our projections for both the B1 yield and B2 equity that Cliff kind of talked about before. So for this deal, since it is a development deal, we don't plan on providing distributions for the first year. However, for the next year, and as the deal continues to perform, we'll be having a catch up and pay preferred returns for both that year 1 and year 2. And then in year 3, we'll plan to refinance and repay out the initial investment. So for B1, you'll notice that in year 3, your preferred return is actually double. Your preferred return should be $27,500. And the reason this is because in our PPM, we are guaranteeing 4 years of preferred returns. So that's also why you'll kind of notice that the IRR and cash on cash is a bit higher than it should be at 11%. For the B2, you can see the returns are going to be higher with that equity split. So we're projecting around 35% levered internal rate of return with a 3x multiple. And a lot of that comes from the fact that this is a development deal. Okay, so our other project that we bought for this fund, one that I'm really, really excited about, is called Nashville North RV Resort. So we ended up getting this one closed kind of middle of August, and we've been working on this deal since Q1. It was an on-market deal where the seller wanted over $7 million for it, and we were one of multiple offers that put on this project. But it ended up going under contract at $7 million. However, the buyer fell through, and we consistently kept in touch with the brokers throughout the entire process, and were able to lock this one up at $6.5 million. So the park offers 90 RV sites with 4 cabins. It has an attractive amenity package in a highly desired location, just 20 minutes right outside of downtown Nashville, which I'm sure many of you know that is a great area to be in and one that is just continuously booming. So the park has, increased demand from this rapid job and population growth from Nashville. It's got a thriving tourist destination, and there's a limited amount of RV parks near Nashville, surprisingly. So really gives this one an edge. And what we really like about the deal, besides its great location and strong customer base, is its value add opportunity that it offered. So it was being as a KOA prior to us buying it. And it offered us the ability day one to come in and create operational efficiency and revenue by eliminating that franchise. So the KOA franchise charged an 8% royalties fee and also an additional 2% fee for marketing and so forth. And with this park being so close to downtown Nashville, it already had a really great customer base. It had great notability. There was no need to be paying that extra KOA fee. So we really saw potential there. Additionally, the park had not undergone any substantial rent increase in the past several years. So there was the ability to come in and increase rates to be more in line with other properties nearby. And the park is one of the only RV communities in the Nashville area that offers monthly spots, which we really saw as a competitive advantage to stay more occupied throughout the year, especially in those off-season months. And you're able to, increase those monthly rents by still being an affordable option to the parks that offer, those weekly stays as their long-term rates. So this property is a more stabilized deal. And what it means for you is it offers a ton of strong cash flow that's going to balance out that Arrowhead development component. So B1 projections are going to be 11% levered IRR and cash on cash. And then your B2 projections are 17% levered internal rate of return and around a 9.5 cash on cash. So Nashville is going to represent a more typical deal that we're going to target within the fund. So great location, performing park, stabilized, heavy cash flow. But we will also look to add some of those heavier value add deals if it's the right opportunity for the fund.
All right, so as we wrap up here, we'd be remiss if we didn't tell you a little bit more about the Climb Capital team. So the Climb Capital team makes up of the 2/3 top rows there, and then on the bottom you'll see myself, as well as Tess Wrights and Doug Spence, the other co-sponsors for this fund. Their company is Honor and Equity, but the rest of the faces on the screen are all the Climb Capital team. So you have Bob and Jeremy, who are the co-founders of Climb Capital, have been doing real estate together for over a decade, as well as Matt Carter, who you've heard from, Tala, our acquisitions analyst, and then we also have Cameron, our executive assistant and investor relations team member, and then Jake Chambers as well as the director of property management, which is the altitude property management combination that Carter was talking about a little bit earlier, and how we have a vertically integrated team. And there's many more faces. If we put everyone who's involved in the management, both the regional and of the park specifically that are a part of the Campfire Fund and will part of it, you'll see a much bigger team that Jake is helping lead. So there's a couple of next steps. If you liked what we've talked about today or have any other questions, you want to see the PPM or answer any further questions and hop on a call, please send an interest email to info@climbcapital.com. From there, we'll ensure that we get you set up with a phone call with someone from our team. We'll also ensure to give you investment portal access so you can complete the subscription documents, as well as transfer your funds for your investment. And as soon as that happens, that's when you'll be accruing IRR with your investment. So far, we're a little over a third of the way completed with our capital raise. So slots are filling up quickly. So please be sure to reach out and we'll be happy to discuss any questions you have. So for now, we'll go ahead and address our Q&A and see if there's anything else that we could discuss to help ensure that we answer your questions today. So the first one I'm seeing that Tala had already addressed. So it was asked, what's the minimum investment, as well as if we could walk through the tax and depreciation benefits for investors. So yeah, the minimum investment is $50,000. As far as the tax and depreciation benefits, that's varies depending on your situation. So you'll definitely want to get a copy of the PPM and the investment deck that we just clicked through. And we have a different version as well that's has more slides. Work through that with your CPA and your tax advisor, and they could certainly explain to you a little bit more clearly how the depreciation will affect your personal tax situation as far as benefits go. We do have the ability for depreciation as well, and because you'd be an equity owner in the Campfire Fund and in these parks, we will have cost segregation studies done and whatnot, and we'll be able to depreciate a lot of items that Carter mentioned earlier, which he was talking about, the tiny cabins that are on wheels. Those are 100% depreciable because they're on wheels. So that helps us stay competitive with multifamily investments as far as depreciation goes. To give you an exact percentage, given we haven't purchased all of the parks yet, since we're purchasing them as we go. Carter, do you want to talk about the distributions question?
Sure. Yes. So one of our other questions was, when will distributions begin? So we are hoping that distributions are going to begin probably 6 months from now. So probably Q1, Q2 of next year. We do have strong cash flowing projects, so we will be looking to distribute those out. We just want to make sure that when we take over these projects, we're really focusing on management and making sure that they're going to be, making money for the long term. So that's why for the first quarter, once we take it over, we might just hold on to those distributions in order to perfect the management and running of the project, and then distribute those out following that next quarter. So with the other Arrowhead project that we have in here, that one will probably not look to do distributions for the entire first year, just because it is a development project. But majority of the other deals that we're targeting tend to be more expect distributions to be coming out next year.
Awesome. Thanks, Carter. So we have a good question here from Chris. And Carter, I'll read it out loud for the people who are tuning at home, but let you answer. So what occupancy projections are you working into the projected return numbers? And are these considered conservative projections?
Great question. And honestly, it kind of depends for the specific deals, right, that we've been seeing. So on a lot of our parks, we look at to have, conservative underwriting on all of them. And we like to see parks that have both that mix of long-term stays, which are monthly renters, and also more of that transient income, which is coming from your weekly and daily stays, right? So for the longer term stays, we are typically seeing in our parks anywhere between 75 to 95 to even 100% occupancy with a wait list for those parks. And that will differ based off of location and even timing for the year. One of our RV parks sees a lot of snowbirds coming in. So their snowbirds and transient travel is really high right about now. It's starting to kind of pick up through January, February, and then they do more of the longer term rentals for the summer as people just want to enjoy the travel there. So typically when we're seeing kind of on a market basis as well, those nightly and weekly stays are anywhere between 50 to 65, 70% occupancy, and then the longer terms are definitely a lot higher. And a lot of our parks where we're buying are places where people want to live full time, and so there are wait lists for our parks and parks that we're buying. That I think Tala actually talked with one of our owners that we're targeting at a park, and they've got a 60-person monthly waiting list. So there is a ton of opportunity for people wanting to stay there. And some of these RV parks and even ours might hold, maybe 6 or a certain percentage of those spots for transient, because you are able to gain higher revenue by renting spots for $50 to $70 a night versus charging, $500 or $600 per month for those.
Cool. Awesome. Thanks, Carter. And a great question, Chris. So that's all the questions that we've got so far. So again, thank you everyone for tuning in today. And if you're watching the recording, we appreciate it. On our screen here, you'll see a QR code you could scan that'll take you to the Calendly link where you can schedule a call with one of our partners here at Climb Capital, or you can go to our website. You can also call the phone number you see on the screen and email info@climbcapital.com. So everyone have a good rest of your day. Thanks for tuning in during the lunch hour. We appreciate it.